Hi, everyone. Today we will be going over chapter 8, which is all about receivables. All right, so just a recap of what a receivable is. Um, a receivable is any money that is owed to the entity or the company. So another company can owe the company money, so it can be business to business transactions. You can have customers that will owe the company money from the sale or service of products, and then you can have all different types of organizations. So what I like to think of is a receivable is maybe an IOU someone else gave to you, and for example, maybe you loaned somebody money and then they said, I promise to pay you later, right? That would be considered a receivable. They owe you money. You should be receiving that money soon. Just a reminder also that current receivables are current assets because you expect to get paid within 1 year or less. Receivables can also take on the name of a trade receivable or accounts receivable. And this is usually from, again, the sale of goods or services with a promise to pay from the customer or another business or organization within 30 to 60 days. We're also going to talk about notes receivable in the latter part of this chapter. And this one is a more formal written instrument. So it is more so of, I would like to say like a loan, I guess you would say, something more of a loan where you have a document and it's a written promise to pay. And not only that, there's usually interest involved in it. So some other examples of receivables that we really won't touch much on is there's tax receivables and receivables from office employees or officers, so forth and so on. All right, so let's talk about what happens when some of the receivables are uncollected, right? So we have this picture, sad, very sad, but just take it from your own standpoint before we put it in business terms. Whenever if you loan, maybe your favorite uncle or cousin money, sometimes they're a little shoddy and sometimes they don't pay you your money back, right? And so at that point, you're like, man, I'm never going to get my money. And so the same can be true for businesses. Most times, whenever they, not most times, but a reality of selling products and services to the public is some people will not honor their promise to pay, right? And so that's what we're talking about now. How do I account for something if it's uncollectible? Okay, but before we get into that, I want to talk about how some companies don't even they shift some of that responsibility. So number one, they say companies may shift responsibility of collecting receivables to other companies. So you have some of your mom and pop, for instance, they may be a cash only business, right? So maybe you've been to a festival or a farmer's market, and maybe they don't have the Squarespace quite yet because they're up and coming or something of that nature. They would be a cash only business. So in that case, they would never really have to deal with uncollectible receivables because, again, either you pay them cash or there's no business. The second instance where the company is shifting some of that risk of maybe potentially not receiving their money is they shifted to credit card companies. So examples of that would be like a Visa or American Express or Amex, right? Where maybe you are a mom and pop, or maybe you've been to a mom and pop store and they don't have their own credit card again. So maybe you have your, Visa card or MasterCard or whatever card you carry. And when you swipe that card, usually, especially if you're a small business, they'll say, hey, if you make a purchase, any debit card or credit card purchases, there's a 75-cent or 50-cent charge, right? And so what's happening is Visa and MasterCard is charging the vendor, right? The mom and pop shop, they're charging the vendor money to process that transaction. And ultimately, what they're also doing is taking more of the weight of that receivable or that uncollectible receivable. So for instance, when you go swipe your card at a business, right? the business, the mom and pop shop get the money right away. Whereas now Visa, MasterCard, and Discover Card, now they're responsible for, you paying your bill. And with that comes some kind of small transaction fee. So the mom and pop shop is no longer responsible for an uncollectible receivable, because again, they have shifted that responsibility to Visa or MasterCard, and that transaction is now between those two parties and not them. Also, you have some companies may sell their receivables. So you have companies where they may have their own credit cards. So examples of that would be like Macy's or JCPenney's or whatever your favorite retailer is. And so sometimes when a company offers credit card to their consumers, some of the consumers, like usual, they don't pay their bill, right? That's just part of the business, right? And so from a Macy's or JCPenney's or whatever other company you can think of, maybe if they need their money right away, they may factor their receivables. Now, what factoring means is you have JCPenney's or whoever, maybe they have accounts receivable. Maybe they have an accounts receivable amount of, say, let's say $500 million, right? That's owed to them from their various customers, right? So factoring says that Macy's will connect with a buyer, the buyer being a factor, and the buyer of these receivables will take all of Macy's $500 million in receivable, and Macy's will sell it to them for maybe, say, I don't know, $325 million, right? And so the factor will usually take that $500 million receivable from Macy's because they're a reputable company and so forth and so on. And then they'll give Macy's $325 million. Now, like initially, you'll probably want to say, well, that's kind of a cheat because again, maybe Macy's is leaving $175 million on the table. Well, Macy's is likely probably taking this example because, again, maybe they need the money right away, or it could be any store, right? I don't want to just say Macy's or whatever, but one of the reasons why they're doing this, again, is maybe they want, excuse me, sorry. So maybe they need some immediate cash flow. So maybe that's one of the reasons why a company will sell their receivables. And so while they'll be foregoing $175 million, or sometimes it's less than that, they would enjoy the immediate cash flow. Okay. So let's talk about what happens if a company does not sell their receivables and they choose to hold on to it. So there's this thing called bad debt. So it's an operating expense recorded from uncollectible receivables. And some famous or familiar names that go along with it is uncollectible accounts expense or doubtful account expense, things of that nature. So what are some indications that an account may be uncollectible? Well, maybe you've never been on that side of the fence, but some indications from a company perspective that an account may be uncollectible is if that receivable or invoice is past due. Another example is if a customer is not responding to collection attempts. So you've sent emails and you sent mail and you've done all of these different techniques to try to collect the money, but no response. Maybe the customer has filed bankruptcy. Definitely a good indication that you will likely not receive your money. Maybe the business closed, and lastly, the company cannot locate the customer. They ghost them, right? So yeah. All right, so let's talk about it from a business perspective. How do we account for uncollectible receivable? Well, there's two ways we can go about it, and that's what we'll spend the rest of our time doing, looking at how we account for uncollectible receivables. Now, the first method is the direct write-off method. Now, we won't spend a whole lot of time here because first and foremost is reserved for smaller companies with very few receivables. So examples of that could be your jewelry stores, or just very infrequent sales or things of that nature, right? Or cash only companies, right? They wouldn't have, they won't have a lot of receivables because they only receive cash. So let's talk about the direct write-off a bit, right? So it's bad debt expense is only done or only written off, or that invoice is only written off when account is deemed worthless. Okay. And then under the allowance method, where we'll spend the bulk of our time is bad debt expense is done by estimating uncollectible receivables at the end of the accounting period. And it's usually reserved for companies with large receivables. So you can think of any maybe Fortune 500 company, you know, your Googles, your Lyfts, your Ubers, Lyfts, and all of the DoorDashes, maybe all of those will be considered large companies with many transactions, many receivables. And also this method is required by GAAP. So if you're a publicly traded company, remember GAAP is the generally accepted accounting principles. It is our level, it is the principles that make everything fair. And so again, most of the companies are using this method if they're publicly traded company. Okay. All right, so let's talk about the direct write-off method. So the direct write-off method is when we deem an account to be uncollectible, we say, okay, I've tried every possible collection attempt, we're just not getting the money. And so at that particular point in time, maybe you're the manager and you say, you know what, I'm washing my hands clean, let's just write it off. So let's take this example. Assume that a $4,200 account received from D.R. Ross has been determined to be uncollectible, right? They've tried every possible attempt to collect the cash and it's not working. So our journal entry to write off this particular account will be a debit to bad debt expense and my credit to receivable. Now my receivable again is going down because again, I am not gonna receive the money. So there's no point of having this receivable on the books when I know I won't receive it, right? So I'm just gonna write it off and say, hey, I'm done, I'm washing my hands with it. Now the question states on the slide, is it possible to recover an account previously written off, right? What if the customer comes back to D.R. Ross and says, hey, my bad, I've been ignoring you for say 3 months. Here's your money. Are you gonna say, never mind, I already wrote it off, keep your money to yourself? The odds of this is being highly unlikely, right? So if a customer comes back and say, hey, I'll pay you the money that's due to you, you will likely take that money, right? You'll say, hey, I'll do what I need to do. All right. So this represents the journal entry to recognize that you are going to receive that money. Now I'm going to pause the video and start a new video, but I will talk about why we go about doing this and what does the initial journal entry look like, okay? So hang tight, part number 2 is coming shortly.